The current trading price for Datavault AI Inc., ticker symbol DVLT, stands at $1.57 per share. The market is currently seeing pre-market fluctuations, pushing the bids slightly higher to $1.58, but the tape tells a much more aggressive story than a single cent of movement. While the board shows a modest intraday gain of roughly 0.64%, the volume profile suggests a heavy accumulation of sell orders stacked against a wall of speculative retail buying. If you are watching the order flow, you are seeing a classic friction point. Retail investors are bidding up the price in anticipation of a heavily promoted meme coin dividend, while insiders are actively disposing of shares at these exact levels. The expectation here is that you are buying into a high-growth artificial intelligence firm on the ground floor. The reality is that you are stepping into the middle of a corporate identity shift, a complex reverse merger scenario, and a highly publicized war between the company's management and aggressive short sellers. This is not a standard tech investment. It is a battleground stock where the fundamentals are secondary to the narrative engineering currently taking place in the boardroom. Most investors look at the name Datavault AI and assume this is a legacy software company that has found a new footing in machine learning. That is the surface-level assumption that keeps the buy orders flowing. However, when you peel back the layers of the corporate history, you find a completely different mechanism at work. Until very recently, this entity was primarily focused on wireless audio technologies operating under a different mandate entirely. The pivot to AI and data monetization occurred through the acquisition of assets and a subsequent rebranding in early 2025. This type of rapid metamorphosis from hardware to abstract data valuation often signals a company attempting to capture the current market liquidity rather than one growing organically from a core product. The market expects a stable technology firm. The reality is a speculative vehicle that is using every financial instrument available, including Bitcoin payments and crypto dividends, to maintain its valuation. Analyzing the intraday action reveals a specific pattern of exhaustion. The stock hit a high of $1.63 earlier in the session, but failed to hold that level, rejected swiftly by selling pressure. This $1.60 region is critical. It represents a psychological supply zone where trapped buyers from previous weeks are looking to exit at break-even. The stock has been drifting in a wide range, bouncing off a low of $1.49. This support level is precarious. If the price breaks below $1.49, the algorithmic stop losses will likely trigger a cascade of selling that could push the stock back toward the $1 mark. The volume today is hovering around 26 million shares, which is slightly above the average, indicating that eyes are on this ticker, but the conviction to push it higher is absent. We need to address the immediate elephant in the room regarding the company's recent strategic moves. Datavault AI recently announced a transaction involving Silex Holding Company valued at $150 million. On paper, this sounds like a massive infusion of value. However, the details matter. The transaction involved payment in Bitcoin and the issuance of pre-funded warrants. When a company listed on the Nasdaq begins transacting in volatile cryptocurrencies and issuing complex warrant structures, it introduces a layer of risk that does not exist in standard equity agreements. This is not just a balance sheet item. It is a signal that the company is aligning itself with the volatility of the crypto markets. If Bitcoin swings 10%, how does that impact the realizable value of their recent deal? These are the questions institutional risk managers are asking, and their hesitation is likely why the stock is struggling to break out past the $2 resistance. Furthermore, let us discuss the meme coin dividend. The company has publicized plans to distribute a Dream Bowl 2026 meme coin to its shareholders. This is an unorthodox, if not entirely unprecedented, tactic. By issuing a digital token as a dividend, the company is effectively trying to force a short squeeze. Short sellers who have borrowed the stock are theoretically responsible for paying the dividend to the lender. If the dividend is a digital token that cannot be easily bought on the open market, the short sellers face a delivery failure. This tactic creates immense tension. It attracts a specific type of retail investor who is looking for a squeeze, but it also alienates traditional funds that cannot legally or logistically hold such assets. You are seeing this tension play out in the price action right now, a tug-of-war between those betting on a squeeze and those betting on a regulatory crackdown or operational failure. This brings us to the short-selling dynamics, which are absolutely critical for anyone holding DVLT right now. There is significant short interest in this stock, and for good reason. Professional short sellers are targeting DVLT because they view the AI rebrand as a superficial wrapper over a business with negative earnings and high cash burn. The borrow fee, the cost to short the stock, has been spiking, recently quoted around 14 to 15% annually. This is expensive. When borrow rates get this high, it indicates that shares are hard to locate. It means that the conviction among bears is so high that they are willing to pay a premium to bet against the stock. However, you must also be aware of the naked shorting discussion that is rampant on forums like Reddit and X. Investors are convinced that market makers are selling phantom shares to suppress the price. While this is a common theory, you must look at the fail-to-deliver data. Recent reports show substantial FTDs for DVLT, which lends some credence to the idea that there is a settlement backlog. This can act as rocket fuel. If the stock price rises unexpectedly, perhaps due to a Bitcoin rally or a new partnership announcement, short sellers who are paying 15% interest may be forced to cover their positions simultaneously. This is the squeeze scenario. But remember, a squeeze is a technical event, not a fundamental one. It drives the price up temporarily, but it does not fix the underlying cash flow issues. We also see that Datavault AI has filed a lawsuit against Wolfpack Research, a prominent short-selling firm. This is a high-stakes poker game. By suing the short seller, the company is fighting back. But legal battles are expensive and distracting. If the lawsuit drags on, it drains resources. If the short seller produces more damaging reports during the discovery process, it could hurt the stock further. Investors need to monitor this litigation closely. A win for Datavault could legitimize their business in the eyes of the market, while a dismissal of the case could be seen as a validation of the short thesis. Comment below with your thoughts on this lawsuit. Do you think Datavault AI is right to sue the short sellers, or is this a defensive move to distract from their financials? Shifting to the business model itself, we need to clarify what Datavault actually does, because the AI label is doing a lot of heavy lifting. The company claims to focus on data monetization. In plain English, this means they provide a platform that allows companies to value their data assets, things like customer lists, proprietary datasets, and intellectual property, and then potentially trade or borrow against that value. They call this the Data Vault. The concept is that in the future, data will be an asset class, just like gold or real estate. They are also heavily involved in real-world asset tokenization, which involves putting physical assets, like minerals or real estate, on a blockchain. This is a trendy sector. The idea of tokenizing trillions of dollars of real-world assets is compelling, but the execution is incredibly difficult. It requires strict regulatory compliance, massive adoption from traditional industries, and a secure technical infrastructure. Datavault is positioning itself as the infrastructure layer for this transition. They have announced deals with mining companies to digitize mineral assets and partnerships in the healthcare space. But investors must ask, are these binding contracts with immediate revenue, or are they memorandums of understanding that may never materialize into cash? The revenue growth reported in the last quarter, up 148% to nearly $3 million, is a positive sign, but it is coming off a very small base. For a company valued at over $400 million, $3 million in quarterly revenue is a price-to-sales multiple that implies massive future growth is already priced in. The institutional activity in DVLT is another puzzle piece. We have seen insider selling recently. When a director sells $30,000 worth of stock at these low levels, it is never a confidence-inspiring signal. While insiders sell for many reasons, tax planning, liquidity needs, it rarely looks good when the company is pitching a massive growth story to the public. Conversely, the company has managed to attract financing, albeit through complex structures. The reliance on convertible notes or equity lines of credit often leads to dilution. Dilution is the silent killer of returns in the microcap space. If the company issues more shares to raise cash, your slice of the pie gets smaller and the stock price faces a permanent headwind. Let us look at the technicals on the daily chart. The stock is currently trading below its 50-day moving average. This is a bearish trend indicator. The chart shows a series of lower highs over the last few months, despite the recent pop. The $1.70 level is now a formidable ceiling. Until the stock can close above $1.70 on high volume, the trend remains downward or neutral at best. The RSI is hovering in the 40s, which is no man's land, neither overbought nor oversold. This suggests that the stock could drift sideways for weeks unless a catalyst hits. What are the catalysts to watch? The primary one is the meme coin distribution date. As we approach the record date for this dividend, we